Hello everyone, Rahul here. Today we are going to take the fourth part of the first chapter of the economic survey. The name of the chapter is Economic Outlook, Prospects and Policy Challenges. Yesterday actually we had a technical glitch, because of that I had to end the video abruptly. So today we'll continue from the previous part where we left in the last class. So let's move ahead. Now, I was telling you about the fiscal deficit and the debt to GDP ratio. So the economic survey says if the deficit targets were to be relaxed, two questions come. The first one is, what would happen to the interest rates? So it replies by that if the fiscal deficit is lower, that is if the commercial debt, their net commercial borrowings are lower, there will be lower interest rate on G6. So debt can be easily be serviced by companies. Suppose PSU introduces some bonds. So these are in that kind of government bonds, because they are backed by the government guarantee. So if there is less demand of money by the government, obviously they will release less bonds. More people will crave for less bonds. So the government can reduce the interest given on those bonds. Okay. So the one more point now I would raise is that the research shows that impact of deficits, that is fiscal deficit, on long-term rates is typically very small and uncertain. That is, the rate at which the loans are provided depends very less on the fiscal deficits. So why? The answer is given below. Because the rates depend on the long-term outlook of growth and inflation, which is this policy is monetary policy plus growth is managed by fiscal policy, inflation is taken care by monetary policy by RBI, and fiscal policy by finance ministry. So always the long-term outlook of growth and inflation decides the rates. So when we know the long-term outlook, suppose in India we have a very young population, we are skilling them, we have great demand of infrastructure, we have a very huge market, 1.2 billion people. So this creates a positive effect for the foreign investors and more chances of great growth. So this is expectations of future path of short-term rates decide the long-term growth and inflation prospects, and hence the determination of long-term rates depend upon these. Okay, so let's move ahead. That is, it wants to say that it doesn't depend on the fiscal deficit but depends on the growth and inflation balance. Okay, so India's case is not as similar as we are talking about. Now the impact of fiscal deficit on long-term rates might be somewhat larger than elsewhere in India, because elsewhere in the world, because most government securities, that is G6, are held by banks. Obviously when the growth decreases or people or the corporates are not taking loans, the most of the money government wants to the banks want to keep is in the form of bonds. Even they exceed their limit, there is a SLR, statutory liquidity ratio, which banks have to maintain. That is, suppose out of their total capital they have to keep around 22 or 23% in the form of government bonds. This was done so that the government can take loans easily, but the banks keep much more than the required. Okay, and now banks have limited capacity to absorb the new bond supplies. So this risk might seem particularly pertinent because over the past few years, banks have accumulated large holdings, as I've already told you. So moreover, they will be acquiring sizable amounts of state bonds, over the next few years, as bank loans to electricity distribution companies are securitized under UDAY scheme. UDAY is Ujjwal Discom Assurance Yojana. What does government do under this scheme? Here the state government takes 75% of the debt of the distribution companies of electricity. Okay, so and then it brings out bonds to repay the debt. So these bonds will be purchased by banks. So this will also add on to the G-Secs. G-Secs is government securities. Okay. But in fact, the risk of oversupply of bonds seems fairly small. For example, a reduction in the fiscal deficit, even if the fiscal deficit is above 3.5% of GDP, implies a lower net bond issue relative to GDP. And banks actually might be eager to purchase additional G-Secs since oil prices is falling, which could lead to lower inflation, which could also further lead to lower interest rate and capital gains on the holdings of banks. Also, at the same time, FPIs or foreign portfolio investors might also increase their purchases of bonds since the RBI has been relaxing the limits on the purchase of government securities by the foreign investors. Also, conversely, if foreign inflows prove small, that is what we are expecting proves to be small, the RBI might itself invest money and buy the G-Secs to assure adequate increase in money supply. And finally, the government might curtail the demand of the bond. So not the demand, the bringing forth of the bonds which it might have proposed earlier. So in India's case, it depends on the fiscal deficit, right? Little bit more than the other nations. That is, policy rates depends upon the fiscal deficits. Now moving on to the next slide. So the economic survey asked, isn't there a risk that large payouts could push up inflation, forcing the RBI to increase their policy rates? But as I have already told you in the last lecture, no, as it is only hike in the public wages, not even private wages, and not even complete fiscal exchange of money of the government. Okay. So in fact, the risks are on the downside. That is, the policy rate might decrease because there are lower oil prices, which is leading to lower inflation. When inflation is lower, the RBI can decrease the policy rate, which can lead to further decreasing of rates by the banks to the corporates for giving them loans at lower rates. So when a slowing Chinese economy can bring down the inflation because the demand is less and the capacity is more to produce. Similarly, impact of fiscal deficit reduction on aggregate demand. Okay, when when the government is spending less and the production is more, there will be less inflation. So to see whether this will be possible, that is to see whether this our fiscal sustainability model that we are proposing is it would be possible or not with the moderate pace of adjustment rather than hastening the curtailing of the expenditure of the government. A careful examination of the medium term fiscal outlook is needed. That is around, we have to see around in the timeline of 2-3 years. Okay, so let's move ahead. So the need to push debt on a downward path. So how can we, our debt can be pushed to the downward path, that is how it can be decreased. So our debt depends upon the exchange rate movements also, because most or much of our debt is also taken externally from World Bank or IMF or whatever. Okay, besides this, the evolution of the debt to GDP ratio primarily depends upon the two factors. First of all, level of primary deficit. Now what is primary deficit? I already told in the last lecture that it is fiscal deficit minus the interest payments. So it is kind of how much debt you bought. So it depends upon the first of all primary deficit. Put simply, the primary deficits push up the debt ratio, but nominal growth can bring it down as long as the growth rate increase the interest rate on government debt. Obviously, when interest is less, interest that the government has to pay is less, and the economy is growing faster than that, we can repay our debts, and we can reduce our FD, that is fiscal deficit. And when fiscal deficit is reduced, obviously primary deficit will be reduced. The primary deficit has been curbed to less than 1% of GDP in 2015-16, which is far below the nearly 3% of GDP recorded in 11 to 12 year. That is, now we have reduced the primary deficit to 1% of GDP. Primary deficit. That is in 15-16 year, 2015-2016, and previously in 2011-12 it was 3% of GDP. Okay. But the nominal growth now has collapsed as the GDP deflator has plunged to the minimum levels, virtually eliminating the gap between the growth and the interest rates at which we have to pay the debt. So, and therein lies the problem. Now, what is first of all GDP deflator? Now, like the consumer price index we talked in the last lecture, the GDP deflator is a measure of price inflation or deflation with respect to a specific base year. We decide a base year. Suppose, for example, India now have a base year of 2004 and 4 to 5. So between this year of 2004 to 5 and the current year, how much inflation has played a role can be brought out via GDP price deflator through a formula. Now GDP deflator of the base year itself is equal to 100. It is taken at 100. And unlike the CPI, that is consumer price index, the GDP deflator is not based on a fixed basket of goods and services. The basket used for the GDP deflator is changed from year to year depending upon the people's choices and investment patterns. Okay. So let's move ahead. Now this graph shows you the growth interest rate differential. Okay, in this what it essentially is telling is that GDP growth is given by the red line and the interest rate, that is at which we have to pay the debt, is given by the blue line. Now GDP growth, when the growth is slow, the interest rate remains approximately same. The difference between growth and interest is very low. So India would not be able to reduce its primary deficit, or it will not be able to pay debt properly. But when the growth rate is high, the gap is more, India can reduce its primary deficit, right? So this graph shows that. And now these graphs, what does this show? The first graph takes into account Uday Yojana. The second graph doesn't take into account Uday Yojana. Here we see debt as the red colored thing. The general government debt is center plus state both. In 2010-11, the debt was decreased to 66%, then increased little bit, and then decreased. Now this debt S, what does it say? This is the debt when the growth was slow. So obviously when growth will be slow, debt will be higher. And this is the debt when growth was slow and Uday was not included. That is, the state government's debt was not included. This is this because Uday has been reduced from this. So obviously the debt will decrease, because Uday is also a kind of debt only, which is taken upon by the state government. Similarly, when the debt when growth was high will be lesser as compared to this, and when Uday is also excluded, it will be much lesser. Okay, so here the central government debt is talked about, and here what we see is when the slow growth is there, the debt will be higher. When the higher growth will be there, debt will fall more quickly. Okay, so it tells us that. Now then the economic survey also counters it by saying that adverse shocks have a way of throwing the debt dynamics off course. That is, some kind of shock can happen, that is externally some demand could reduce a lot, or oil prices can vary a lot, which can lead to increase in our debt. That is, if Gulf Cooperation Council countries, that is Gulf countries which produce maximum of the oil, they decide that we will decrease the supply of oil. Obviously the oil prices will increase, which will lead to further decrease of our foreign reserves, and hence there will be more debt. So let's move ahead. Now we are talking about the fiscal policy. We need to navigate between the two devils. There are also very good arguments for strategy of aggressive fiscal consolidation, that is reduction of the fiscal deficit, and also equally good arguments for strategy of moderate consolidation. Moderate, remind the word, that can place the debt on a sustainable path while avoiding imparting a major negative demand shock. Obviously, when you try to curtail the demand of the expenditure of the government, so what will happen is that the money will be less in the economy. When money will be less in the economy, there is always a risk that our growth can fall down. So we need to be aware of this risk. Now coming to the next topic, it is the external outlook. So last year economic service had identified a weak external environment as a major medium term risk for India. The remittances, that is money we get from our foreign workers or migrants, have held up despite a dramatic decline in oil prices. Now most of our migrant workers are working in the Gulf region, and these Gulf region countries are the oil exporting countries. So now the price of oil has decreased, but still our remittances, that is the money we are receiving, we in the sense when the migrant workers send the money to their family members, it comes in Indian economy. So you see the remittances have been constant. It has not fallen even after the oil prices have fallen. Also what we see is the net flow of passengers have not been dependent upon the decrease in the oil price. Okay. So the Indian economy and the foreign exchange earnings was buoyed by this non-decline in remittance flows. Still, prudence warrants that monitoring this source of earnings, because it is quite possible that with the oil prices remaining low in the near future, oil exporting countries will eventually will force to curtail their use of foreign labor, and there might be like extradition. I should not use the word extradition. Transfer of migrant laborers from the oil exporting countries to India, and also decrease in the remittances. So let's move ahead. Exports. Now what we see currently, that there is decline in the commodity exports in the 3 quarters. That is, there is 18% decline in the commodity exports, and much of this was due to falling commodity prices. That is, oil prices have fallen, and subsequently many other like food items or whatever is transportable, the prices of that has fallen. But the decline in non-oil dollar exports and export volume is also there. Not only oil dependent, but also non-oil dependent dollar exports, a decline we have seen. Now, exports of commercial services has been stagnant for the last 3 quarters. That is 16 years. Last 3 quarters, that is April to June, July to August, July to September, and October to December, has seen a stagnancy in the export of our services, whereas our average growth during the time period of 2006 to 11 was 17%. So this will be a very pertinent problem, as we are hugely dependent upon exports of our services. So the question the economic survey raises is whether this recent export performance is explained mainly by decline in global demand or decline in competitiveness of India as related to other countries' exports, or it is related to exchange rate or some other factors. So let's move ahead. So it is noteworthy that in the 2000s, India's export of manufactured goods and services were above the line of best fit. But note that the services outperformed the manufacturing. I will show you here. Yeah, I am talking about 2000. This is 2000. Here it is 2000. Here we see that India's manufacturing is just above the line of best fit. That is, best fit means when our GDP increases, exports increases proportionately. That is, export is proportion to GDP rise or growth. But India's export was higher than the relative increase in the GDP growth. Similarly, in the services too, are you seeing here? 2000, India was just on the, you can say just on the line of the best fit. Okay. For a word, there is also similar but less pronounced pattern, especially for services. This is of India. These two graphs are of India, and these two graphs are of word. Here we see less pronounced pattern of India, of word in services. Here you see 2-3 years are there when there is rise above the best fit, but here we have 6-7 years of rise above the best fit. Okay, but in the word's case, we see that exports in the manufacturing have risen a lot, and India has lagged behind. As we know our story, that we migrated directly from primary to tertiary sector without importance being given to the secondary sector. But in the last 2 years, however, India's services exports have been more affected than the India's manufacturing exports. And also the word service exports. See, for the last 2 years, see here, we have been stagnating while the word services are on the best fit line approximately, and also India's manufacturing have declined 15, but it's it is not as grave as India's services. So it is India's export of services that has changed in the most significant and perhaps most alarming way. As one can see the problem looking at the market shares of India's exports and services. It has approximately flattened out, and it is also more puzzling as we see that composition of services is more favorable than manufacturing, as the Asian economies to which we export manufactured goods have uh, have decreased growth as compared to USA, where we export services. So when the US is not booming, when USA is growing quickly than the Asian economies, then we should have more growth in the services, but this remains an enigma. Similarly, the other point the economic service says that why the flattening of the services export is puzzling is rupee has depreciated against dollar. This should give more incentive to the service exporters to export the services, as they can make a more buck out of the exports, as $1 is 70 rupees, as contrary to the 50 rupees before. I'm just giving an example. So let's move ahead. Now India has been compared with China. Now, to achieve growth potential which has been achieved by China over the period of past 20 to 25 years, India needs to make a lot of changes. Now this figure 17 plots China's global market share in manufacturing exports, and it is a huge rise. It is rising and rising. But see here, India's services and manufacturing was approximately at the same place. Services was at the same place in the 90s, and in 2004 exports was 1%. You can take China's as 2%. That is not much of a difference. But see the growth of China and see India's services have little bit risen, but manufacturing has been essentially stagnant. Okay. So what do we see here? To achieve a similar trajectory, India has to increase the competitiveness so that it can increase its service exports. So the economic survey says that currently India's services export is about 3% of world exports. So what it has to do is it has to increase it to 15% of world market share in services. That is, we have to export 15% of world's exportable services. So that is a sizable challenge, and recent trends suggest that a major effort at improving competitiveness will be necessary to reach this 15%. So let's move ahead. Now coming to the other topic of the trade policy of India. Now our economy have changed over years, but the trade policy and the positions we have taken have not changed with the economic turmoil or the economic changes that we have experienced in India. So now we will take these issues one by one. The introspection is needed on 5 issues. First one is providing support to farmers in light of the WTO rules. The second one is mitigating the impact of erratic trade policy on farmer incentives. The third one is reconciling the big but poor dilemma that confronts India in trade negotiations. Fourth one is dealing with the ongoing stresses brought on by the external environment. And fifth one is engaging more broadly with the word on trade. Now we will discuss these issues slide by slide. These 5 issues are there. we will take it up now. Now, agriculture and WTO. See, the first issue is providing support to farmers in light of WTO rules. Now, agriculture and the WTO has been mainly dealt in by the Doha Development Agenda that started in 2001. That is the meeting of WTO meeting in Doha, and it was continuing till now. So, what demand India has raised here? It has raised that India should have special safeguard mechanism. The special safeguard mechanism embodies the right to impose trade barriers if there is a surge in agricultural imports into India. Now, you know that most of the developed economies give lot of subsidies to their farmers, so it reduces the price of production of crops, and also the developed countries farmers export these goods, these agricultural products at very low prices, so which leads to problem for India's farmers if the exports come to India. But there is one critical but overlooked question, that to what extent does India needs special safeguard measures? In the Uruguay round in the 80s and 90s, many countries including India were allowed to set a ceiling tariff bindings. Ceiling means that it can set a huge tariff up to 150% of the agricultural products which are being imported into India. So, in the most of the tariff lines, there was considerable gap between the applied tariffs and the tariff ceiling. That is, I will give you an example. Suppose India can impose till 150%, but India has imposed 5% or 10% on the most of the agricultural products. So when the imports of agricultural products from developed countries rise, India can immediately increase this 5% to 25% or 30% or 40%. What is this need of special safeguard mechanism? It is not understood yet, as economic survey says. Now, one more thing I would like to mention is that India's discussion of SSMs, that is special safeguard mechanism, should not be complete as a position of sovereignty of India, but it should cover only a small part of agricultural tariffs, that is tariffs on milks, dairy, fruits, hides, where India already have high tariffs, and there is very less scope to further enhance the tariffs as it will cross the tariff ceilings. So here it can come to compromise with other developed countries or other trading partners in agriculture. Okay. Whew. And you should also know that India has obtained a very hardened legal guarantee in 2014, which made the Bali Conference decision permanent and put it on a sound legal basis. And this was also repeated in Nairobi, that India's concerns will be taken account into. So it is open that this SSM is essentially necessary or not. Now, especially at the time of farm stress, India must have the freedom to provide support to its farmers, that is food security, public holding, both of which affect the farmer interest. Food security should be given to the people, and also public stock holding, that is FCIs buys the agricultural production from the farmers. The open question is its appropriate level and form that we should provide support. The particular policies which are being defended by the government in the WTO platform are the ones that India intends to move out, because it's because of its negative impacts. For example, decline in water tables because we are supplying water absolutely free of cost, overuse of electricity and fertilizers which are degrading the soil also, as well as taking out huge waters and also wasting the electricity. And also the farmers are burning the husks of the crop after they have harvested the seeds. This is also leading to the environmental pollution, and recently the question came in mains that why there has been more pollution in Delhi as compared to Mumbai and Chennai, or Mumbai and Kolkata. So one of the reason was because of the burning of husks in the Punjab and Haryana. The air brings it towards Delhi. Moreover, the government is steadfastly committed to providing direct income support to farmers and crop insurance, which will anyways not be restricted by the WTO rules. So two scenarios are there. At the time of Uruguay round, India was a net importer of food and decided that it needs a lot of room to maintain border protection. That is, it will apply tariff and non-tariff barriers. Okay. And it was less concerned with the domestic support provided to the farmers in agriculture. That is, for example, producer subsidies or minimum support prices. So previously that was India's choice. But after 20 years from the Uruguay round, India's position in agriculture has changed. It has become more competitive in agriculture and it now relies relatively more on domestic support. Okay. And less on the tariff protection for agriculture, both to sustain domestic production and to address the low income for farmers. So India's WTO obligations could predominantly be based on this domestic shift away from the border one. India could consider offering reduction in its high tariff and instead seek more freedom to provide high level of domestic support. This would be especially true for pulses going forward, where high MSPs may lead to where the high MSPs may be necessary to incentivize pulses production. This would be good for India, and India's trading partners should be handled diplomatically, that they should accept this shift. Now let's move ahead. Volatile trade policy. Now India's trade policy has been very volatile. In 2001, 9 changes in tariffs were done. In 2012, many changes were done. So the India has not been consistent in keeping its tariffs. So the unusual volatility in the agricultural trade leads to many changes within short period of time in tariffs. So for example, when the export price increases, domestic scarcity happens because farmers would like to export more. So India imposes export bans. But when export prices decreases, this is decrease and this is increase. When the export prices decreases, import will happen at lower prices, and India will impose import duties as it will want to prevent the cheaper agricultural products to come to India, which will affect its farmers. So these kind of policies hurts farmers and consumers, because as farmers produce less, because of unpredictability of India's policy, there will be more scarcity and hence obviously high prices. Now the economic service suggests that farm policy should include import-export policy and MSP policies, which should be announced in advance, and it should be changed only in exceptional circumstances. So this is very important. Now you should know that our farmer produces goods, but the aadhatis which take the goods in the market take all the profits, and consumers also get costly product, that is costly vegetables and products. Farmers get low income the brokers or the intermediaries earn most of the money. So if the government would have announced a policy in advance and also done the market reforms, the farmers will have advantage and consumers also will have advantage. It is not like that if the farmers earn, the consumers will be at loss and they will get the vegetables higher prices. Because of these intermediaries, there is the problem. So let's move ahead. Now the big but poor dilemma. Now India is poor, so India should get trade concessions from the developed world. But India is also very big economically, so the other economies or other trade partners want reciprocity from India, that India should open its market and the other economies will open theirs only. Now in 70s, 80s, India in WTO was following broadly non-reciprocal low trade. Because India was having very low trade, so the other countries didn't mind कि हमें क्या फर्क पड़ता है. But today, India's market is very big. So the other countries are demanding the reciprocity, that open your market too, only then we will open. ऐसे थोड़ी. So the solution is multilateralism. Why the solution multilateralism? Because the other economies are shifting to the regional trade agreements. Very important. They are shifting to the regional trade agreements, and this is killing the multilateralism. That is part of WTO's mandate, that most of its members should come to consensus regarding the trade policies and they should open their markets. So there is only one way forward. In return for similar actions by its trading partners, India, China and other similar countries must be willing to offer to open their markets and undertake greater commitments in the context of future WTO negotiations. Also the solution rides it, India can use its bigger market as a bargain point to market for its market interest abroad, that is mobility of labor. Like suppose it can send to Japan, it can send to US, so it also solves the job problem in India, and India will also get remittances from foreign lands. Okay, so let's move ahead. Now dealing with the ongoing stresses. Now the global environment is obviously weak. China has slowed down, so it has led to chain reaction all over the world. We normally hear chain reaction, but the economic survey has mentioned chain reactions. So what will happen when China slow down? Steel and software exports to China suffers. Obviously, India will be exporting less to China as demand is less in China. Chinese companies also have more capacity. They will start dumping their products in India. Also, USA slows down when China slows down, and hence service exports from India to USA also slows down. Okay, so because the economies are intermingled with each other, the effects have to be there. So there is only one way forward. In return for similar actions by its trading partners, India, China and similar countries must be opening their markets. That I already told you. Now India needs to respond to the weak global environment in the three ways. First of all, through the exchange rate. It can relax the rate if capital flow is less. That is, if less foreign money is coming inside India, it can depreciate its currency. It will lead to more exports and hence more foreign exchange coming into India. Similarly, intervention in foreign exchange markets when inflows are robust. India can make intervention in foreign markets when we have adequate foreign returns, that is foreign exchange coming to India. India also needs to be cautious about any further opening to inflows because it can strengthen the rupee and kill the exports. Okay, so let's move ahead to the second way. India should strengthen the procedures that allow WTO consistent, hence legitimate actions against dumping, which is done by China many a times for the electronic goods. What is dumping? That is artificially reducing the prices of products below the market price, so that it can increase the market share in particular economy. China has done this in toys, for example, in India. Similarly, for the subsidization provided by the developed economies in context of agriculture, India can put countervailing duties so that the agricultural prices becomes at par with the prices in the Indian market. Similarly, the surges in imports can be protected by safeguard measures, like some import quota can be there, that only 5% of this much product can be imported to India. Okay. The third point is we should eliminate the policies that favors the foreign manufacturing and gives negative effect on the Indian manufacturing. How we'll do it? We will quickly implement GST, because GST will lead to reduction in the tax rate and it will bring in efficiency. Okay, and also the tax benefits that the foreign firms earn will reduce. And even if there is delays in the implementation of GST, we can remove the countervailing duties on the countervailing duty exemptions. Like some products, India gives exemptions in countervailing duty. It will remove the exemptions, so countervailing duty will be applied on that product, and the product will become at par with the Indian products. So what are the prerequisites for trade opening in India? Now India needs to decide that it wants to be pro competition or pro business. India has been pro business but not been pro competition. Now every nation wants exports because it brings in foreign money, foreign income. That is in the income in the form of dollars and whatever currency, so that it can pay later in dollars. But they are skeptical about imports. But the nations forget that the imports bring efficiency, because when the better products enter in a market, the domestic producers will be forced to improve the quality of their products and also cut the costs. So they will economize, they will become efficient, and also when they become efficient, they will produce more, and this more production will go towards export. Obviously, when we turn to pro competition, some non-competitive firms will exit because they were surviving on the basis of gains given by the government in the form of exemption and subsidies. Some companies will become stressful, they can be hand-holded by the government. Some will dislocate, they will move out from India. But India needs to bear this transitory cost of trade liberalization so as to enhance the efficiency, so as to increase the production. So when the India will liberalize, that it will decrease its tariff barriers and non-tariff barriers. India will have more negotiating power in WTO, because when India will liberalize, what will happen is that the other countries will not go towards regional trade agreements like TPP, Trans-Pacific Partnership. India has already lost in terms of intellectual property norms that has been decided in the TPP, because India decided not to take part in it. So now, if in future India needs to join this partnership, India needs to accept without negotiating, because it has already been decided by some partners. So if India liberalizes, obviously India will be given more space, and it will give boost to multilateralism. Now it will also boost the Skill India mission and Make in India. Obviously it will boost Make in India and Skill India. Why? Because Make in India is itself dependent upon efficiency of the manufacturing firms, and Skill India will be workers which will be working in the firms. So in some ways, that ambivalence between greater foreign competition stemming in turn from the domestic politics of disruption and exit is at the heart of India's difficulties with the WTO trade agreements and the trade policy. So India needs to liberalize more by decreasing tariffs. So that's all for today. Thank you everyone for listening to this lecture. Please like, comment and subscribe to www.decipheris, and please like our Facebook page. Thank you.